Well, when it comes to the economy, we are in a year of transition, moving from slow growth to faster growth locally, nationally, and globally. That will no doubt result in several other changes, such as slightly faster inflation and hopefully better hiring trends. One additional change that comes with faster economic growth is higher interest rates, something we have seen, or not seen rather, for a while. For perspective on this important question, we turn to U.S. Bank Wealth Management Senior Equity Strategist Jim Russell, who is with editor Rob Dahlmeyer in the studio. Rob and Jim.
Hey, thanks. I don't know if I've ever heard the term higher interest rates. That must be some term from some other planet.
Right.
But when higher interest rates are around, which investment categories do better and which don't?
Rob, it's a great question. You're right. We haven't seen higher interest rates for some time. The Federal Reserve's been extremely active, keeping interest rates low, trying to revive the economy. That looks like that's probably winding down a little bit. Now, just to back up for a second, the Federal Reserve does control very short-term interest rates, the Fed funds rate and the discount rate specifically, but investors, you and I, actually control longer-term interest rates, 2-year, 5-year, 10-year. So different investment categories actually perform well, and a couple really don't. You can see from the chart here, and this is empirical evidence going back to 1976 when you had leisure suits and a few other things going on. Commodities actually perform pretty well. These are monthly returns for different categories, up 1.1% on a monthly basis on average. You can see the S&P 500 also does pretty well. Right. Real estate investment trust, or REITs, reasonably well, and bonds do not do well in a higher interest rate, higher inflation environment, which we do think that we're moving toward slowly but surely. Higher rates probably in store for later this year, probably next year as well.
How do stocks do? Obviously, most of our viewers here own stocks, whether they think about it or not. If you've got a 401k, you're in the stock market. How do they do when rates rise?
You know, it depends on how far and how fast rates rise. Stocks do pretty well if rates rise just a little bit and maybe even gradually. Right now, the benchmark 10-year Treasury bond yields 2.75%. So if you kind of want to use that as the interest rate, as many investors do, we're kind of in the sweet spot right now. You can see on the left-hand side of the screen that really when interest rates are low, again, monthly returns from the stock market are pretty high. We do think we're transitioning kind of to the right-hand side of the screen, and that is, again, higher interest rates. And as we move from left to right on the screen, you can see each category of interest rates really represents a bit more of a headwind to the stock market. And we don't think rates get out of control, but we do think rates are on the rise and probably mitigate some of the rises we've seen in recent months in the stock market.
So which parts of the stock market do you want to be in when rates are rising?
That's the key, right? And that is everybody's 401k is exposed to the stock market. You want to be smart about that. Usually when interest rates rise, it means that the economy is actually doing pretty well. So there are some economically sensitive sectors of the S&P 500 that do especially well. So let's take a look at what those might be. Technology, average monthly returns do normally pretty well. Again, a little bit less than a percentage point. Conversely, though, utilities and also telecommunication stocks, phone stocks, do pretty poorly in a rising rate environment. So something to keep your eye on as we move and transition into this higher rate environment that we see.
Well, great information, Jim. Thanks for being here.
Thank you, Rob.